ask your positioning, but give us a bit of a sense of how does that impact your investments?
So maybe I'll give you kind of high level, and I'll ask Ryan so just where the strategy comes from is what I would describe as a deep appreciation for asymmetry. And in investing, you want asymmetry in your favor, which is why you don't want to short stocks. What I mean by that is you want investments where the risk of loss is much smaller than the potential for gain, or if you take, in fact, a risk of an entire loss, that the opportunity for profit is many multiples of the capital that you put in. And that you can find occasionally in equities, but in the kind of equities we generally traffic in, these sort of dominant, well-capitalized, investment-grade businesses, they can be great compounders, but you're not going to make 10x, 20x, 100x in a relatively short period of time. But in the sort of macro space, what's interesting is we live in a volatile world, and there are very few investors that kind of operate both in the equity space, where you're sitting on boards of directors, you're following lots of different businesses, you're learning about the economy by virtue of the kind of day-to-day business experience. Buffett should have a very good view on the economy by virtue of sitting on top of Berkshire. He gets the numbers every day. He's seeing what's going on in everything from truck stops to retail to shipping, railroads, et cetera. We do not have the same asset base as Warren, but we do get those insights, and you get a lot of insights by reading conference call transcripts. So we're sort of fundamentally equity investors, and from that we get insights into the economy. The other kind of part of the macro business is what sort of macro traders do, and they look at a lot of government data, which of course is always wrong and always corrected, so it's a kind of in and of itself sort of complicated space. Interesting insights emerge. When you combine those two things, occasionally you have a view that's completely disparate or separate from what the rest of the world thinks. And if you find an investment like that, or if you come to that kind of a view, like you think the economy is much stronger than people think, or you think the economy is much weaker than people think, or you think rates should be much higher than where they really are, or inflation should be at a different level, occasionally you can find an instrument, some kind of option, derivative, or otherwise, where the payoff characteristics reward you enormously for your view if you're right. And you can, because the payoff's so large, you can afford to be wrong a number of times and still have that strategy be really profitable. So that's kind of the philosophy, and that's led to a number of our most successful investments, certainly as measured by multiple of capital and even by kind of gross dollars made. But maybe Ryan can talk about sort of the economic backdrop and what we think.
Sure. So I think what's interesting, if you kind of go back to maybe the end of last year, beginning of this year, inflation, which has been really the key buzzword, if there's been any, in the last several years, it was starting to come down to a level which was pretty consistent with the level that the Federal Reserve targets, which is about 2%. At a